or like Ryan said a few weeks ago, I did a segment on garbage stocks, and underneath that YouTube video, Thomas asked for a review of Waste Connections compared to Waste Management. So let's take a deeper dive into these businesses. Now, Waste Connections, WCN on the TSX, currently trading at a price of $241.20. Again, these are quoted in Canadian right here. $62.6 billion market cap and a dividend yield of about 0.72%. Waste Connections provides non-hazardous waste collection, transfer, disposal, and resource recovery services in the US and Canada. And Waste Management, which is WM on the New York Stock Exchange. Again, these are all here are quoted in US dollars. Price of $219.98, a market cap of about $87.7 billion, and a dividend yield of 1.52%. And they provide waste collection, hazardous and non-hazardous, transfer, disposal, and resource recovery services in the United States, Canada, Western Europe, and internationally. So let's get into it here. Looking at their performance from early 2024, Thomas is 100% correct. Waste Management has outperformed Waste Connections by about 10%. But if we zoom out and get a snapshot of the last decade, Waste Connections has actually outperformed Waste Management by about 175%, with Waste Connections returning 750% and Waste Management returning 575%. Looking at their footprint, both Waste Connections and Waste Management have significant exposure to the US, but Waste Management's exposure to the US is more significant at 95%. Another difference between the two is that Waste Management has under 1% of their business within the UK and Ireland, whereas Waste Connections is just located in North America. And again, both are very similar, with most of revenue coming from commercial and residential. But Waste Management also has some other lines, such as their healthcare solutions, where, from my understanding, they, again, are actually dealing with more hazardous waste in that division. Now, if we look at their recent financial results, first with Waste Connections, these figures are all in US dollars. Revenue was up 7%, which was driven by solid waste pricing, but reported volumes were down 2.6% as they were shedding underperforming contracts. The year has already been an outsized year of acquisitions, adding approximately $200 million in annualized revenue, and management has been talking about significant acquisition deal flow, expecting to close another $100 million to $200 million in acquisitions later this year or by early 2026, with more to follow. And looking at earnings per share, it was up 5% to $1.12. Looking at Waste Management, again, quoted in US dollars here, revenue was up 19%, driven primarily by their recent acquisition of Stericycle and higher yield in their collection and disposal business, as well as higher volumes primarily in their landfill, recycling, and waste management renewable energy business. Earnings per share was $1.80 per share, up about 6% from the same period last year. And management noted the increase in earnings were primarily a result of reduced operating expenses as a percentage of total revenue due to operating efficiencies and cost controls. Now, looking longer term, we can see, first looking at Waste Connections here, the company has a revenue compound annual growth rate from 2015 to 2024 of about 17%. Cash flow from operations compounded at about 16% over the same period, and the dividend has compounded at a rate of 14%. Looking at Waste Management now, revenue has a compound annual growth rate over the same period of about 6%. Cash flow has compounded at 9%, and the dividend has compounded or has a compounded growth rate of about 8%. So looking back, when we were looking at the long-term stock price performance of the businesses, to me, it makes sense to why Waste Connections has outperformed by about 175% over the last decade, given its better growth. But it is also a smaller business at roughly half the size of Waste Management. So again, it just does make sense considering the law of large numbers. Now, before I move into the guidance, let's quickly look at their balance sheets. Waste Connections has a trailing net debt to EBITDA multiple of about 2.8 times, while Waste Management's is about 3.4 times. If you recall my last video, GFL's was at about 3.8 times, but they had targets to bring it down to about 3 times. So Waste Connection's balance sheet is slightly better than Waste Management's and GFL's. But again, all these businesses are quite similar. If we look at the share counts, both have been slowly buying back shares over the time. We can see that here. And now moving into each of the companies' fiscal year 2025 guidance. So Waste Connections revenue is expected to be up about 6% compared to last year, while net income is expected to be up 85%, adjusted EBITDA up 7.5%, and free cash flow up 7%. And looking at Waste Management, revenue is estimated to be up 15%, which organic growth is looking to be approximately 5%, and acquisitive growth being 10%. Adjusted EBITDA is expected to be up 15% as well, and adjusted free cash flow is expected to be up 23%. So again, relating back to Waste Management's 2-year outperformance over WCN, given their stronger growth forecasted throughout fiscal year 2025, it makes sense to me why Waste Management has outperformed by about 10%. More of the outperformance has recently came in this year. But it makes sense to me given the higher growth rate compared to Waste Connections. Looking at the valuations, Waste Connections is trading with the highest valuations comparatively, while Waste Management is at a bit of a discount. So to conclude here, Waste Management and WCN are very similar businesses, but Waste Management has more exposure to the US and some international. From a long-term buy and hold perspective, I think that either WCN or WM are defensive holdings with an investment horizon of 5 to 10 plus years. Waste Management has outperformed recently over the last 2 years, given the stronger growth guidance. However, Waste Connections has outperformed over the last decade due to better consistent annual growth in cash flow. Now, some trade-offs here between Waste Management and Waste Connections. Waste Management does have the most levered balance sheet of the two. They're pretty similar, really, though, but this is something to note. Waste Management also pays a more attractive dividend yield, but Waste Connections has been growing the dividend at a more rapid pace. If someone purchased the stock back in late 2017, Waste Connections would be providing an effective dividend yield of about 2% now, while Waste Management would be providing an effective dividend yield of 4.4%. And this is just because of the dividend growth over time. And of course, lastly, Waste Connections trades at a slight premium. So, I really think that it's a toss-up between the two. Even if we're pulling, GFL into the equation, I really think all of them are decent businesses. If Waste Management can continue to grow its free cash flow at the solid double-digit rate expected in 2025, I think that it may be the better option. I'm not sure if it can or if that is sustainable, if it can continue to grow free cash flow, into 2026 and 2027 at the outpaced rate. Looking at Waste Management, I will also note it is likely the better dividend growth stock for someone that wants to invest in or wants more yield, essentially. And there is the disclosure.
Excellent. Well, gun to your head, which one are you buying today?
I think I might
Just
go
say
with
neither.
Waste Management. Really just because I want a little bit more yield. Like I see these businesses as kind of a long-term, just long-term growth play, and I want that dividend growth, and that I'm starting out with a better yield as it is. Like I said, if you had bought in each of these stocks in 2017, held them all the way to today, based on your initial purchase price, Waste Management's going to be yielding you about 4.4% now, rather than the 1.5% that I quoted earlier if you had bought it today now. Meanwhile, Waste Connections is the effective yields about 2% because of that dividend growth, compared to if someone was to buy it today, they'd be getting about a 0.7% yield. It's too bad that Brett isn't on this podcast, because I was going to put a gun to both of your guys' heads and see which you would be more interested in. But again, there's such similar businesses.
I like the dividend growth for sure. And it likely slightly lower valuations, a
Mhm.
little bit more levered. So,
Yeah.
potentially that's why, but yeah, likely
Yeah.
the waste management.